start with bonds. So we had jobless claims come in above expectations, and I think this is very notable. That goes with our theory of how if we do get a recession, bonds actually will probably not do too good because they're anticipating the deficit will continue to be a problem, even worse when a recession hits. And I think that's what we saw today with bonds dropping the way they did after we got those jobs numbers showing a weaker than expected labor market. And funny enough, the NASDAQ did the opposite. So the way I'm seeing it is we've kind of gone through the worst case scenario. And now it's like even a slowdown or uh, somewhat recession is bullish for equities, uh, but not too good for bonds. That's the way that I'm seeing it. But at the end of the day, I would still consider this a bear market rally in the NASDAQ. We're still bearish trend. And it's very likely that we're going to tap Momo. Maybe today was the top and continue lower or just chop from here. That's my expectation going forward until we get some trade deals coming on the table. We start seeing the deficit issue starting to get tackled, which it's very possible. And I think that's why the NASDAQ has been acting the way that it's been acting.
Yeah, I tend to agree with a lot of those points. You're right. I think that the deficit's in a situation. I know we keep talking about it, but when it comes to bonds, it's somewhat important. And the deficit's in a position where, if you get this shallow type of slowdown recession, it's probably okay for bonds. It's if it becomes a severe recession where you have this issue that of the deficit just getting worse, right? And the Fed's inability to cut rates. And we touched on that a lot in prior podcasts, so I don't want to go too deep into that. But I think that's probably what's holding bonds down or acting as the weighted vest. I think another thing is there seems to be some uncertainty around um, the continuing budget here, right? Like we have budget numbers. So there's a lot of things that are just happening tomorrow, right? So if we look on the calendar, tomorrow we're gonna get let's see, we're gonna get NFP at around 8:30 Eastern in the morning. Estimates are for 130,000 jobs, and then we're gonna get on top of this, we're also going to get the fiscal year 2026 budget proposal from Trump that he said, or they said, the administration said today that that'll come Friday, which is tomorrow. So maybe we'll see some sort of indication as to where they are trying to bring the budget in the next fiscal year. We were told that there's going to be some cuts. We were told that there's going to be some more fiscal responsibility. And today, Trump did say that he's looking. He's been saying this, but he said it again that he's looking to have these this tariff income offset taxes and pay down the debt. And I think that's a bit exaggerated. But what he's trying to say is that he's trying to add another revenue source, right, to the government while adjusting the income tax, making it more net neutral. From what I'm seeing, than actually like positive. So we're gonna have to have some substantial cuts in spending to offset that, I'd think. Um, Nonetheless, that whole deficit issue that we're seeing is problematic for bonds, but it's not necessarily end of bonds. And I think a lot of people get lost in the sauce with this and saying like bonds are uninvestable. And when in reality, I think the situation is a bit more complicated than just saying, look, the deficit's at 6%, right? Bonds are uninvestable. Because I mean, I know this is a crisis, but you can go back to pre-COVID, going into COVID, right? The deficit went from 3 to, I think it was 13 or 3 to almost 15%, something like some obscene jump, right? And bonds went from TLT went from something along the lines of 100 to 150. So to say that, just because the deficit's at 6% or 6 to 7% means bonds are uninvestable doesn't necessarily hold true. It matters really where the market's implying the future deficit is going to be. And that's what bonds are, right? Bonds are an inflation and growth component, but they're also a credit component. You have term premium, you have a baked in premium into your yield as to how reliable the underlying issuer, or in this case, the United States, is going to be in paying back your debt or paying back its debt without necessarily inflating it away. That's what term premium is. So I think that that's what has been spiking lately, and if that comes down, that alone, like here's a good example. The 10 years at 4.2 right now, but if we look at term premium let's see, term premium on a 10-year, right? It's 50 basis points. We saw term premium as low as 10 basis points in January of last year and in the summer of last year. So if we go back to the 10-year, that's 40 basis points off here. That means that the 10-year could be at 3.8 to 3.6 without necessarily anything changing except forward expectations of that term risk in bonds. And a lot of things can change that. So I think that to write bonds off completely is probably not a good idea, but I do agree with you, Artie. Look, these are just trading like they got the lead vest on, and it looks like it. Every breakout's nothing can run. Everything's getting rejected. Now we're even getting rejected under Momo. So until we even clear Momo, as long as we're below Momo, this is trash land for now.
Yeah. And for bonds to run as well, it's also very relative. Depends on how the rest of the world is doing. And
This is true.
if the rest
This
of
is
the
true.
world is also running large deficits and they're actually in a worse position than America, even if America has a large deficit, bonds are still going to be the better investment.
Yes. So like also there was a viability trade that really hit the market hard the last month, and it seems to be somewhat reversing. Now, it's not exactly cured, where DX is only at like 100, but the rapid decline here, I think, has added this move. I mean, even if we could try throwing term premium on here, just as a quick, like, let's see, let's throw a 10-year on here in price scale. Yeah. So I would say that the dollar's rapid fall has added some has prevented term premium from falling the way that it would have normally in this situation, like last summer, right? Term premium fell all the way down 10 basis points. It was following the dollar pretty closely up until Liberation Day. And you see the dollar falls and term premium spikes. And I think that this was, again, you had some foreigners, a bunch of people, not maybe some central banks, right? Japan, unloading some treasuries and therefore widening term premium because you're baking in the idea that U.S. debt is no longer as desirable in an environment where U.S. exceptionalism isn't as dominant. And I think that trade might have bottomed over the last 2 weeks. That doesn't necessarily mean the market bottoms, but I have a feeling like there's the possibility that things like the Europe to SPY ratio, right? When you're comparing like European equities to SPY to American equities, maybe this has somewhat of a topping look. I think at this point, after coming aggressively off the lows, you could do China as well. This it looks like it topped a bit earlier. Also, not really up near highs. So I think that if we start to see these relative offsets come back into balance between foreign equities and American equities, dollar should rally. And if the dollar rallies, I think things like gold probably don't do as well, right? Gold seems to have almost peaked when the dollar bottomed. So dollar reversing is not going to be good for gold, and it might actually be better for bonds longer term if the dollar can revalue higher and therefore bring some confidence back behind the greenback, therefore killing some term premium. I think that's probably what needs to happen for bonds to shape up.
Yeah, I think what we saw recently was kind of an overextension of fear. And now, like, we have the EU coming out and saying that they've got a trade deal in the works and there's going to be a trade deal coming up pretty soon. And I'm sure there's many other countries out there that are doing the same. So unless if those trade deals come out and they're terrible and uh, Trump pushes back on them and makes things worse, I think things are going to get better from here, and we might see a reversal in all of that, all of those moves that we saw over the last couple of months. That was just an exaggerated move in terms of America's downfall, pretty much.
Yeah, I think that the idea I tweet about this quite often, but look, everyone stopped care. Everyone was said it was over for America, and we were at levels that we weren't even at decade level lows on the dollar. So I was very it was kind of shocking how anti-American the entire world got so quickly, and I think that it's just the speed at which it happened added a little bump to term premium, but the way or even just ex-US strength, the way that we've been seeing, and I just think the way that it happened was so rapid. I mean, we were talking literally within a month, under 4 weeks of like going from questioning to like full blown like exceptionalism is over style fear. I think we see that debate now. How that progresses though is going to be a very interesting situation because if you look at it from a perspective of risk assets, right? Like let's just look at the Nasdaq, which is mostly tech. So let's take the S&P 500, right? So the S&P 500. Now we have erased pretty much almost all of the April decline. So any post Liberation Day negative impact to the stock market has been mostly erased in the last since Liberation Day, which is a month. So interesting thing here is that I wouldn't be surprised. So the GDP Now model that everyone's been freaking out about the last 2 or 3 months, we saw the negative impacts start picking up in early March due to imports. So I wouldn't be surprised if most retailers or any product, obviously non-software related companies, anyone with physical product, has imported a substantial amount or a significant amount of inventory, right? Pre-Liberation Day and pre-tariff, and they're in the position where they can eat away through their inventory, not so much impacted. And this, I think, can provide a very cloudy outlook, right? Because you're having all these good earnings, and I mean, Apple today, I think they guided that they're going to take like a $900 billion hit if tariffs remain in place, right? From tariffs in Q3, I think they said. So these are all things that have to be worked through. If inventory is brought in early, you have the ability to eat through it eat through a lot of inventory at pre-tariff costs. So it'll help with inflation too. The odds of inflation rapidly picking up if companies are sitting on inventory is lower than as if they weren't. But at the same time, companies are also operating with a limited amount of pricing power. And I think that if these tariffs even stay remotely in play the way that they're doing, it's going to yield a situation where we end up in a month or two at a crossroad where now the tariff impacts finally start to bite. And I think that unless we get some more or some clear direction from the administration, that's probably the underlying risk at the moment. I have to say, from like a gut risk, if you're looking at this just discretionary without like looking at models or anything, like the tariffs were announced 30 days ago, pretty much at this point. And in the last 30 days, or they were the announcement of the tariffs 30 days ago was announced well in advance. So Liberation Day was pre-announced. Companies had a lot of time to move inventory. We saw that with the GDP Now model. So there's a glut of inventory based on the economic models that's sitting in the country that's exempt from tariffs. So I think that for us to get a more accurate picture as to how significant these tariffs are, we have to eat through that inventory first. And I guess what the market is implying here is there's a good chance that the administration can walk back a lot of the negative tariff effects before those inventory costs appear post Liberation Day. I have a feeling that's what's going on here.
Yeah.
So then, as everyone says, nothing ever happens, right?
Pretty much. Yeah. Nothing ever happens. I mean, it like, do you think the Nasdaq's going to go bullish trend on this bounce, or do you think it's a bear market rally?
Well, I think there's a lot of things in control right now. So the first thing is we're in a bear market still. That's not to be ignored. Can we shift out of a bear market? Absolutely. But look, you have VIX at 24. Okay. It's pulling back. It's on a first, it's all, you could call it a one leg pullback here. Will it bounce again? Probably. Where does it go? We'll have to see. Right. I think that the idea that we can just walk away from this scot, like, scratch free into a bull market is possible, but unlikely given the fact that the last 30, 60 days has specifically the last, since February, so call it last 3 months, 2 to 3 months, has destroyed sentiment. Because and one could say, oh, sentiment's in the garbage, great time to buy. This is true. But I think that there's this underlying fear that you're one headline away from basically going back into some downward spiral. And I think that that kind of needs to be shaken loose. And for that to happen, I think we need to really take the tariff risk or mute it significantly or take it off the table completely. And unless we do that, I feel like the market's going to try and test low, see if it can, look, market's going to dip again at some point. And the question is this was a higher low. The next low, maybe it's get another higher low, and these would all be constructive signs as you're under Momo and we're in bearish trend that we're kind of basing for a reversal back up into a new bull market. But to get bulled up here, obviously the trend's bearish. I can't say I'm bulled up here, but I could say that the price action is slowly becoming more constructive towards bulls, but you're not out of the woods yet.
Yeah. Yeah, we really need to see like a constructive trade deal with the EU and China. Those are the main ones.
Yeah, like most of the Latin American countries don't count, unfortunately. Um, not I don't even think Canada counts, to be honest with you.
Yeah, no, I don't think so. I think I don't think he even wants a trade deal with Canada. I think he wants to bankrupt Canada and then purchase it, take it over.
Art of the deal, fella.
Yeah.
I don't even think India is as significant either, to be honest with you. I mean, it has more significance in some of the LATAM countries, but it's not. It's no China or Europe. So I think that's what the market's waiting on. I think that would probably be the first good sign. That would be the real sign, I should say, that volatility is shifting into a lower gear if we start getting trade deals passed. The Ukraine deal was a good deal. Obviously, when I say it's a good deal, not necessarily the deal itself, but the fact that there's progress in the administration probably adds confidence to the market. Like, if it doesn't necessarily matter that Trump's inking mineral deals or whatever, the fact that Trump's inking deals, I think, has a net positive impact on risk because it's showing that there are things that are getting done and more deals are likely to come. That's the way I look at it. So as long as you're actively moving forward, I think it's good. But I think that the administration is also doing a phenomenal job at talking this up. They really are. Like, if you think about it, you notice that the market stopped acting erratically once the administration just started focusing on saying that there was deals like coming. As soon as they started saying deals are on the way, progress is being made every day, the market pretty much bottomed. And I
Yeah.
think that they're able to manipulate the narrative like that. And it's listen, you know, cheers to them. I mean, this is the way that they were. And now, when Trump whipped out that poster board, it literally went from a 100 to 0 so quick.
Yeah. And we're seeing it in
So
the bond market too. Like TLT has been bouncing, but I think TLT is really just waiting for some concrete evidence that the deficit can be tackled. Like if he makes a trade deal with China that is going to pull in way more money and actually then bonds can actually start calculating, okay, like is this enough to fix the deficit issue? And that's probably when we're going to see that weighted vest lift off of TLT.
probably, yeah. I mean, another thing that's interesting that are trading interestingly is utilities, right? Like, they are so close to going bullish trend, they just don't want to, and they're also at like this $80. I mean, I should put this in the charts. $80 on XLU is like, and this is dividend adjusted, of course, but This is like the no pass zone.
Yeah. Yeah, it scares me. Like once that goes bullish trend, like if we get locked into a trade, like is it just going to collapse cuz it's kind of in that collapse zone?
I don't know. We might have to look at some possible hedges there, but I think that the caveat to this whole thing is if you snap this zone, like XLU could go on ridiculous runs. So if you could snap this zone, I feel like you're breaking multi-month resistance into a bullish trend, into a slowdown regime. It's like all the stars align where you could start putting on some rocket ship price action.
Yeah.
So it goes either way. But for sure, to your point, yeah, this thing's been like a wall, $80 wall. $80 XLU call sellers doing great. Let me tell you,
Yeah.
doing great.
Yeah, I think putting on some hedges would be a smart play if we do get that trigger.
Yeah, just to hedge out some uh some $80 call wall risk or whatever you want to call it here on XLU, is just preventing you from getting snuffed. But I do think that we do need to see some progress with the inflation swaps too. I know that like a lot of the issues on inflation swaps are on the front end, being like the tariff impacts or whatnot. But the real problem is not necessarily that the front end is elevated, but the long end isn't really falling. See, like, I guess a good way to break this down would be if we had um if we had the 2 year up here, right? This is the 2 year and this is the 10 year. If we had the 2 year ripping, but the 10 year absolutely crapping the bed, the spread would be dropping into negative territory even deeper, right? Which theoretically isn't a good sign for bonds, but I think bonds would look past the fact that it's falling so much because of transitory tariff impacts, which are being seen as completely reversed on the long end, right? You go further out, long end's completely diving. But what you're seeing here is you're seeing that the front end lift, back end kind of fade, but it's not breaking down. Like 10-year swaps are not below their September lows. They're not, to be honest with you, they're not even below they're barely below their December lows. So like if we disable the twos, you'll see what I mean. Like 10-year swaps are not in a position where I think that they show, like, look at historically, right? We're pretty much back to 2023 levels. So all that improvement on the, like, look at the summer of last year. We got down to 2.3 on 2.2 on the pretty much 2.3 on the 10-year inflation swap. Right now we are sitting at 2.4. So we were down there briefly right after Liberation, right into Liberation Day, and then we snapped up given the whole tariff impact and everything. And I think that given the elevation of the longer end and the failure to kind of break down, this is what's helping add term premium to this is what's helping basically keep the long end elevated. So I think we need to see some resolution here to really switch the TLT trade back on, and that can happen kind of quick. It's not necessarily over, but like meaning bonds are not investable. It's just we need to see some progress on inflation expectations, and I think that just seeing the long end remaining anchored while the front end lifts for the transitory effects is not a good sign. I think bonds would do a lot better if the front end was lifting and the long end was crapping the bed. I think that would the long end would actually like that.
Yeah.
And the fact that we're not seeing that, I think, is somewhat problematic.
Well, we did see gold pull back a little bit. Like that's a bit bullish for bonds, I would say,
It's a bit
but
bullish, but
maybe
that's
it's
dollar related. That's dollar related. Yeah. So I think what's happening there is, I know what you're saying. Like, pull some hot air out of gold. Maybe you can put some pressure on bonds, right? But like the move in gold is primarily due to the fact that the dollar is rebounding. I mean, the dollar has been driving a lot of the gold flows or the gold price the last the last month, right? So a dollar rebounding hard, like if DXY gets to 102, 103, I think gold's gonna have a tough time. I think at this point you're essentially short along the dollar by being short gold or vice versa. Um, Nonetheless, I do think that if the dollar does revert up, um, that will be positive somewhat for bonds because remember at the end of the day, long-term bonds are just dollar denominated. They're dollar denominated assets with interest. So they're cash equivalents, not from a risk perspective, but from a product perspective, right? You need US dollars to buy US bonds. Therefore, they're dollar assets. So if the dollar reversed, the dollar fall in the way that it did, scared many out of US assets. And I think the dollar reversing, at least initially, has the counter effect of reshoring some demand for US denominated assets. And I think that's what happens there initially, and then we see what's going on. But I mean, we could finish this podcast off with Bitcoin because I know everyone's talking about that, right? So Bitcoin's doing some very interesting things here. We're slowly getting bullish trend, and it looks like it wants to go, but it just is, but it isn't type of thing. Like
Yeah.
it's been doing this thing where it's popping and fading, and I hope it's a pop and a break here, and we can start getting some action going, especially for those that are just purely like long-term Bitcoin holders. This you want to see this pop and go to 100K. Not saying it won't, but I think that we want to see Bitcoin at least test on dips and hold Momo. That's probably, if you're a long Bitcoin, that should be your line in the sand. You've gotten incredible reversal here in price action right off the lows, and it's holding up quite well. So if and when we get Bitcoin dips, ensuring they hold Momo would be a very positive and bullish market style behavior. So bull market style behavior is going to be holding those dips to Momo if we get them.
Especially if we can get a slowdown regime and start grinding higher in growth expectations, that's just going to add fuel to the fire.
Yeah. We're pretty close, but we're not there yet. But if we do get there, this will be an adequate long along with utilities if they can flip trend. I think we'll wrap it up there. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.